Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation.
All right, starting the Federal Reserve. The Federal Reserve holds interest rates steady and crushed hopes that we will get the first rate cut in March. Anyway, this was the first FOMC meeting of the year, and Vince and I are going to break that meeting down and tell you what it all means. Vince, how you doing today, my man?
I'm doing good, man. I can't complain. It's a little
You know what
rainy
else? No, I'm joking. Go ahead, bro.
Nah, it's a little rainy out here in San Francisco. It's supposed to rain for like the next few days. Might get some sun on Saturday, but all in all, doing good, man. Doing good.
Well, that's good to hear, man.
Really? So no.
So Jay Powell kind of confirms some things that we've been saying on this pod or show for the longest, but also, bro, I've changed my stance on the recession. I'll get into it deeply at some point here, but I changed my stance, bro. I actually don't think that we're going to get a recession. So we're going to get into that. And do you have anything to add, bro, before we kind of get into what Jay Powell said?
No, I do still think we're going to have a recession, but I'll wait till you get into it, till I get into it.
All right. So let's get into it. So this is one thing that has been confirmed that we've been talking about on this podcast. And these are his exact words, by the way, guys. Our strong action have moved our policy rate well into restricted territory. And so that kind of hammers home that point on this is not about cutting rates because we see a recession or recessionary activity on the horizon. We're cutting rates because we're in very restrictive territory in terms of real rates. And so we've been talking about one of the reasons that they could be cutting rates is because they wanted to bring real rates down. And, you know, once again, real rates will be considered whatever the nominal rate is. So at this point, it's still 5.25 minus the inflation rate, which at this point, depending on which measure you use, if you say CPI, 3.1%. And so if you do the math on that nominal inflation rate, that would bring real rates to 2.3%, which is extremely restrictive. And to give you an idea, like we didn't even have real rates for a decade during the ZERP period. So real rates, like I said, they didn't exist. So the nominal rate was at 0 to 0.25, and inflation was basically running at 0%. And so we didn't even, or 0 to 1%. And so we didn't have real rates at all. So there was no restriction. And so 2.3% real rates currently, you could argue like, oh, that alone, if we stay here, could cause a recession. And so now getting that back down to a more respectable level, AKA 150 basis points from here, getting nominal rates down to 3.75%, and inflation sticks around 2.5%, let's say 3% for easy numbers. That means the real rate will be, 0.75 or less than 1%. And so that's not extremely restrictive, but it's restrictive enough to where it doesn't cause too much stimulation, causing inflation to return, and then we're back at square one.
What I basically took from that, I'm gonna use another basketball analogy, probably help people understand too. Jerome Powell, they don't want to redline. So there was an interview about a player talking about LeBron James and how he plays at such a high level for so long. And what he said was that he's never redlining. And what he meant was that he's never jumping as high to the max that he can. He's not running as fast. Like his capacity is really high. Like let's say he can play at 100%. He normally plays at around 80%. And then he starts to pick up the pace when he gets to the playoffs, when things count more, so that he doesn't get injured. Kind of the same with the economy. Like they don't want to just operate with rates this high because something's inevitable to break. Just like when you got your foot all the way on the gas on the car, like it'll keep going, but eventually like the engine will, like shit'll start to happen, So that's basically what I took from that.
Yeah. If LeBron played at 100%, he probably had a career of Derrick Rose. I love you, Derrick Rose. You were my favorite player at one point, but yeah, the injuries, because he went 120% every single game. So yeah, that was a good analogy.
Yeah, certain principles just apply to all facets of life, and this is one of them.
I like it. All right, so he also said that we believe that our policy rate is at its peak for this tightening cycle, as well as we will need to see continuing evidence to build confidence that inflation is moving down sustainably towards our goal. So policy rate, by the way, he's just referring to the Fed funds rate effectively, or interest rate that is set, which is what I just referred to in that 5.25 number. So right there, he's basically hammering home, because I remember hearing some people saying that there could be more rate hikes. And at one point, I was even saying that months ago, but he just hammered home that there are no more rate hikes. He killed that, like Nick T or Nick Timmerow said, and I brought that up on the other pod the other day. So he's also hammering home the fact that we most likely or won't get a rate cut starting in March. In fact, it's going to be pushed later out. They think that next month is just simply going to be too early to tell which direction they should move in terms of that policy rate. And so people were expecting, the market was expecting a rate cut, the first rate cut in March. It was like a 90% chance. I haven't looked, but I'm sure that has changed obviously after this meeting. If it's not 0%, I would be surprised because he literally said it. And that's one thing you can give Jay Powell credit for, is his forward guidance over the past couple of years in terms of telling us what he's going to do. Because damn, he done it. The boy done it.
And he done good too. It's like, nah. Now, what I take from that is, I talked about this like months back. Like, it's like first off, the inflation is the most lagging indicator in the economy. And then second off, it's like, as the Federal Reserve, you're steering the ship that is the United States. And if you compare a ship to a jet ski, if you're in the water and you turn the wheel or the whatever you call it on a jet ski, you'll change direction really, really fast. But if the United States economy is like a ship and you're in this big ass ship and you got the wheel, you can crank it all the way, turn it all the way, but it won't start turning for a while and it'll turn really, really slowly. So basically what he's saying is that they don't want to act too early because they want to see what direction the ship is going to go after they've already turned the wheel. Because if they get ahead of themselves and they act too fast and they have to turn the ship the other way, well, hey, now not only do they not know what direction they were going on in the first place, but now they got to wait to see what direction they're going again. So you really just have to be patient. And JT, you said this a lot. I do think Jerome Powell is doing a fantastic job steering the ship.
Bam. You should start a new YouTube channel, bro, called Vinalogies. Now, another thing he mentioned is that, we're prepared to maintain the current target range for the federal funds rate for longer if appropriate. So basically, once again, hammering home. You can see he does a lot of hammering home certain points. He likes to make sure that nail is in all the way before we move on. He's just letting us know, like, look, I'm prepared to stay here for as long as I need to. So we don't have to cut in March, we don't have to cut in June, we don't have to cut in July if we feel it's not necessary. So although the market and even the Fed are projecting rate cuts this year, based on certain data, they could just stay here if inflation comes back up, because that's basically what it comes down to. If we see another uptick in inflation, not a certain portion of inflation. One thing he said is, I'm not interested. This was in response to a question, paraphrasing here. We're more interested in the aggregate number of inflation versus the contents of inflation. So rather than each line item of inflation and what each line item is doing directionally, they just care about that aggregate number. And so by saying that, he's just prepared to hold rates there as long as he needs or they need.
Yeah, I think that's a good move, like not jumping the gun too fast. The biggest thing you'll always hear him say when anyone asks a question is two things he always goes back to. It depends on the data, and our job is to ensue maximum employment and low inflation. And the chips will just fall how they may if they, focus on doing that one thing. So yeah, that makes sense. Nothing really too much to add to that.
So all in all, I think based on his vibe, I think that he actually believes that he achieved a soft landing. I'm not going to go against him, and I'm not 100% with him, but I'm like 80% there, to be honest, at this point, because there is no data at this point that I'm seeing. And people are trying to point to something as niche as like, okay, look at these manufacturing numbers, but those are recovering as well. And so it's like, there is no data that I see that points to a potential recession. And I remember saying that the labor market could be the first thing that cracks. But I mean, the unemployment number has went from 3.4 to 3.7 in like the last 3 months, which is a pretty soft cooling. ADP payrolls came out today. I think it was like 107 versus 150 expectation. 150,000, those about 150,000, which is cool, but also still kind of cool. Not like it's not breaking. And then housing, I talk about housing all the time. Prices are going to keep going up. Inventory is just not about to flood the market. And so there is nothing that tells me there's going to be a recession here in 2024. There's nothing, literally nothing.
In 2024 or just period?
In 2024. Of course, that could change, right?
Okay.
But I'm always an advocate for, hey, look at the data and make sure you adjust accordingly.
Don't just sound like the fucking Fed. No, I'm just playing.
No, they don't just be like, oh, this is going to happen. I'm a fucking moron. It's going to be a recession. No. I mean, you're going to be stuck. One of them guys calling a recession for 10 years. Like, bro, at that point, we listening to the other shit. Whenever you start talking about doom and gloom, we ain't listening to you no more. Don't be one of those guys, please. So anyway, yeah, I just don't see a recession at this point. And he was asked if basically, does he think, we've achieved a soft landing? He did say, we're not declaring victory at this point. We have a ways to go. That's what his response was. But that's what he's just going to say to make sure he doesn't make the markets go crazy. But trust me, after that meeting, my boy went in the back. I'm talking about he didn't even make it out the building. He went to the back, maybe like 2 other dudes, and he had a glass of champagne. And he said, good job, boys. He's drinking. He's having a ball right now because he's feeling good because he did the impossible at this point. Or it seems like he did. Remember, the data could change, man. The data could change. But right now, everything is pointing at Jay Powell being like, this is history he's making right now.
Yeah, I'm not gonna lie. The vibes I got, just from his demeanor was, let me tell y'all what the fuck going on around here. I'm gonna tell y'all what y'all want to hear, but
he might as well have had on a pinky ring, bro.
Pretty much. He really, we got this shit in the bag, but I'm gonna take y'all a little questions and all that shit. But in regards to the recession piece, yeah, I agree. It does depend on the data. Sand, I'm not sure if he actually believes he's achieved a soft landing or not. Obviously, he said not. I do think it's too early to tell whether he believes it or not, because kind of like calling that a good landing on a plane just because the wheels work and everything working good and you going down, the runway could it could be an earthquake. The wheels could fuck up. You never know. And just going off of history, I really want to wait until, to be honest, I hope that we did get a soft landing because that's better for me as an investor. It's harder to short things. It's more risk. It's just easier to get long. So history says once rates are lowered, that's when we see the market bottom. But also I'm aware that historically, this time really is different. People always say, oh, this time's different. This time is really different. Historically, once rates have been dropped, it's because something's broken, but nothing's broken yet. And if we can get inflation down and they can lower rates and it's a peaceful lowering, then hey, you know what I mean? You kind of just gotta call it like you see it. So we'll see.
Yeah. Nah, that boy Jay Powell, that boy up there, he swung his coat jacket when he turned off the stage and everything.
Mm-hmm.
He turned his head to the side. They started asking him a question. He said, hold on. Go ahead. That boy was on one today. So yeah, all in all, I think he's feeling good about it. Like you said, I agree. It's a good thing for us if we do have a soft landing. And I'm going to reiterate that I don't think that there's going to be a recession for all those reasons that I mentioned before. And yeah, man, it's crazy. It's crazy.
Up. Hopefully it's up. And to be honest, thinking about one more thing, I wouldn't be surprised if there wasn't a recession until Q4 or next year, just because it's the election year. Because I feel like they would want to hurry up and get it out of the way so the markets can go back up so that they can get reelected. But if they're going to keep pushing it back, that window is going to get too small.
So part of the reason why people wanted a recession because they thought this tighter interest rate environment would hurt consumers way more than it actually did. But realizing that consumers were not hurt at all, the labor market was not hurt at all, well, a recession isn't so important. So the election argument, it kind of goes out of the window because of that. Because it's not about the election. It's about the fact that they realize that they literally can avoid a recession at this point. And so they're going to choose so because all the data that would point to a recession is not there. And so they can continue with what they're doing. Anyway, guys, let us know what you think down in the comments. If you enjoy this type of content, let us know. Tell your friends, tell your aunties, tell your grandma. Hey, subscribe, and we'll see you on the next one.
Bye.